I gave up managing billions to become a better investor. Episode 20, Very Early Earnings Season Insights. Hello. We talked about the concept of the corporate earnings season, its importance and relevance for all investors. Last time, let's talk about the real thing. And I kind of feel that the initial way that the corporate earnings season starts, for me at least, is with WD-40. Now, you may or may not be a WD-40 aficionado, but as the company themselves say, we live under the kitchen sink, in the garage and toolboxes of the world. And certainly that's how I think about the company, which they also describe as, and I love this quote, the blue and yellow can with a little red top, which if you've seen a WD-40 product, you know exactly what I'm talking about. It's a company which I'm a personal user of, particularly when I'm trying to fix my bike or something like that. But I know people use it for many other different ways and means. So therefore, an interesting company, something which I guess people have a decision whether to buy the product or not, to use the product, etc. There are, I guess, other alternatives available. But a company which I like as an insight, because it's not just centered in the Americas or Europe. It's a global company, about 50% sales in the Americas, 30-odd% in EMEA, Europe, Africa, Middle East, and the remaining 20-odd% in Asia Pacific region, which I think is really helpful because it gives a very good insight as to what the consumers, industrial, sort of centered companies are thinking about stuff. You know, basically whether they're buying WD-40 product or not. How is WD-40's pricing going, sales, profits, and related. So in terms of the numbers themselves, they were fine. I mean, this is actually the end of the quarter three period for WD-40, a little bit different from the average company who are at that sort of quarter two, half one approach during this corporate earnings season. But there you go. Some companies have different earnings dates and related. So WD-40 at the end of their quarter three period, and they were saying, look, the numbers are basically going to hit expectations, albeit perhaps slightly at the bottom of the range, which sounds a little bit negative. But what I observe is that actually progress continues. The company's still growing, which is good, not just from a sales perspective, but from a profit one as well. So double ticking the box there. But as always, that's kind of just not enough. Just because they're broadly hitting targets, there's progress and growth. What's already valued in? What are they saying? What are they thinking? This is what really the corporate earnings season is all about. It's not about that simple, have they beaten or missed, which I know is beloved by financial TV and related. It's about what does it mean? What's already factored in? Where are they going tomorrow? Because as we all know, investment it's a forward-looking game. It's where, yes, what has happened is important and insightful, but what really matters is what's going to happen and what you're going to think about. That far more interesting. So numbers were good. If we look kind of geographically, we get some even better insights from WD-40 beyond sort of the headline numbers. I like the fact that across both the Americas, EMEA region and Asia Pacific, the company's talking about not just growth, but also strong pricing power. Super, super important. If there's one thing to look out for in the corporate earnings season across the vast, vast majority of companies and sectors, it is pricing power. Do you have it or not? Companies that are doing well positively, it's all about ultimately the pricing power scope, the ability to slowly increase your prices, but not see sales horribly fall away and ultimately your profitability diminishing in a terrible fashion. Pricing power is so critical. If you do have pricing power, you're a good company, you've got great product, you've got product which is attractive, even during times of perhaps iffy underlying economic growth and related. Pricing power matters materially, and I like the fact that the pricing power remains good here at WD-40. They have rose some prices, but, you know, it hasn't meant that sales have fallen off a cliff. In fact, they've got sales growth. Yes, some of the comps are quite easy, certainly with some of the difficulties in, let's say, China, because of lockdowns, material lockdowns a year ago. Also things such as pulling out WD-40 pulled out of the Russian Belarus markets, obviously for good reasons, about a year ago. Consequently, the comps there are starting to get easier, and across when it's perceived from an overall EMEA basis. And when you look at that, pricing power, you know, decent growth levels, there are ticks in the boxes here which are good. Now, what does it mean apart from the fact that they're still growing, on a forward basis in different geographies? Is it kind of important to see what they're doing in these geographies, how that's going? It's kind of interesting to see that expectations, medium-term expectations for forward growth, sales growth in the Americas is in that sort of 5 to 8% range. But actually, if you look at EMEA, just either side of 10%, or Asia, where you're actually talking more about 10 to 13%, you're actually seeing the sort of some of the medium-term, at least sales growth potential for this company, which kind of I would expect, given the nature of what it is, the fact that obviously they started in the States and have slowly expanded around the world with their products as the years have moved on. So you'd expect that naturally to be more growth scope in the, let's face it, still more materially growing EMEA, certainly Middle East, Africa, and Asia regions. So you'd expect that to occur over time. But what I thought was particularly interesting, apart from all of those sort of headline numbers and sort of medium-term sort of sales growth hopes, is the fact that actually they're still kind of doing kind of two things of importance. One is they're still generating free cash, which I love. As I've discussed before, revenue, fine. Revenue growth is good. It's better to have revenue growth than not. No doubt the profits matter more for investors, but profits you've got to be a little bit careful of, mainly because is it going to be sustained? Are there special matters which have occurred, which is a big tick in the box today, but maybe not for tomorrow? Free cash is ultimately a bit more insightful, certainly in terms of not just sustainability of how a company is doing, but ultimately how you should value a company. Let's face it, if you had a company with maybe good profits, good revenue growth, good profits, but a lot of debt, as an investor, you've got to factor that in. Hence the importance of EV/EBIT rather than PE ratios, in my opinion, but a subject which I've talked about at previous podcasts a number of times before. No doubt I'll mention it later on today as well. But additionally, the thing about free cash is that you get a lot of insights and choices that the company can make in terms of what do they want to do with the free capital? Do they want to just return it as a dividend? Do they want to hold it on the balance sheet? Do they want to do more capex and reinvest it back into the business, make acquisitions and related? As WD-40, a good chunk of their free cash flow is coming back as the dividend, which is running just shy of 2% at the moment. So the company's not generating at the moment huge free cash, but I know they're also investing into their business, which is good. New product in this area is important and something which WD-40 talk about a lot. It's important to remain relevant after all in this sort of space. But I also observe that they're buying back a few shares, not too many, but a few. And I find that interesting. We'll talk about whether I think it's ultimately smart or not when we talked about sort of valuation and whether I think the shares are cheap or expensive today. What I do also observe, though, is that despite the tick in the boxes on revenues, profits, and free cash as well, I also note that the company is still underperforming its targets, and they have this sort of three-way business model target between gross margins, cost of doing business, and EBITDA. And their hope is that their business model is 55% gross margins, 30% costs of doing business, and an EBITDA, because EBITDA, after all, is gross margins minus cost of doing business, is their EBITDA target is 25%. If you look at what they're doing today, or certainly in their quarter three numbers for the current year, they're running at 51% gross margins versus their target of 55%. So underperforming there, although doing better than they were doing this time last year. The costs of doing business was running at 32% versus the 30% target they held. And actually 32% is a touch higher than it was last year. So again, reflecting the fact that there is a bit of inflation out there, a bit of cost. Again, we can talk about that a little bit later. And as for EBITDA, it's running at 20%, which is better than it was this time last year. I guess reflecting the fact that they've got better gross margins. Cost of doing business may have been higher, but the gross margins were even better in terms of their improvement. Again, reflecting their underlying strong pricing power. So the EBITDA metric at 20% was better than this time last year, but still below their target. So as you can see, the company is improving, getting better, certainly compared to a year ago. We can guess some of the reasons why: easy comps versus lockdowns, an improvement from having to close down their Russia, Belarus business. So I guess those issues, those challenges, those costs have kind of started to move away now. But it's still kind of running below expectations, below their medium-term hopes, which is kind of interesting. And inevitably, it raises the question as an investor, well, are they actually going to achieve an improvement to sort of hit those medium-term targets? Or actually, are those medium-term targets just something which was put together a few years ago and just, is never going to be hit? Kind of interesting to see that. I like the fact when companies, and this is where listening not just only to the conference call, but looking at the presentation that the company has pulled together too. Again, this is why websites are so helpful. It's not just listening to the conference call, but you've got to look at the presentation as well, because then you get some great additional insights way above just hearing the company talk. And if you look on the presentation document, you'll see that they included some 10-year historic growth CAGR information insights, which is fantastic, because as investors, whilst, as I say, we should always be looking forward and thinking going forward, we can only invest, after all, looking forward. It's really useful and really nice when a company is not scared to put down some historic numbers over the last 5, 10, or in some cases, number of decades, years. Of course, I guess there's an inevitable linkage. If a company's been doing all right over that time period, they're not so shy about doing it. And unsurprising, when I look at the last 10-year numbers, historic CAGR numbers of WD-40, they look absolutely all right, in the sense that most metrics are moving forward over that time period. Yes, revenues are going up. Yes, margins are going up. Yes, their profits are going up, ticking the box across the line. And, you could say the same broad observation about their dividend policy and related, inevitably. But what you can also see is that this is the company which isn't yet sort of fully mature. They still have clearly lots of scope still to grow, which is good. Again, something you would expect for a company which is 50% US, but then 50% in the rest of the world, with lots of developing economy exposures, which you should expect to grow over time too. So when you've got that interesting mix of decent pricing power in the developed world and growth scope in the developing market world, that's a good combination, unsurprisingly. Something which we'll talk about a lot more later on in the earnings season, because it's a big thing for many consumer-centered stocks and related. What I find interesting, though, really fascinating, is that the company is, in terms of margins, the US is running below the margins in EMEA and in Asia Pacific, which I find is kind of intriguing, and perhaps again indicates the fact that WD-40 realizes that in order to keep making progress in the United States, it's a bit tougher. Market's a bit more mature and related, whilst elsewhere in the world, perhaps there are maybe fewer competitors, more edge to the product, particularly in a sort of a developing market zone. So consequently, maybe there's a bit of easier scope there to sort of continue growing. Anyway, when I look at the fact that the company is not shy about talking about how some of their targets that they put together a number of years ago have not been fully hit, I actually find that refreshing. I don't like companies who say everything's great even when it isn't, because frankly, you've got to be realistic about everything. And as we've talked about before, frankly, you're not going to be a good investor unless you acknowledge the fact that you make plenty of mistakes. I still make plenty of mistakes as an investor, but you learn from them. And if you accept it, learn from it and move on, then guess what? You're probably going to get better. You're going to get stronger as an investor. And it's the same with companies as well. Anyhow, what I liked about the WD-40 sort of presentation and webcast was that they were talking about some of their medium-term focuses. And unsurprisingly, it's not just about going international, because frankly they're doing that already. I guess it's more going even more international, which is the tick in the box. I like the chat about premiumization, which again is a popular concept for many kind of consumer or industrial companies. Absolutely correct to see that. Speciality, specialisms are important too. And this is where sort of pricing power is kind of helpful and insightful, because I kind of find as the world, if you like, gets smarter, new competitors come up. If a company is making profits, then company number 2 or company number 3 might say, well, is there a way that we can, take a part of that? Maybe we can, come into this business. Maybe we can do something which maybe we'll run it at a lower margin, but hey, we can still make some profits from it. And so specialization is important too. That sort of premiumization, specialization, internationalization sort of focus, I think it's a smart thing for any company. It's been around for a number of decades to do, because let's face it, maybe there's a new competitor who is just going to try and take some of your market share unless you innovate and change and evolve over time too. Similarly, talk about the use of digital opportunities is also ticking the box. I'm glad that there wasn't overt AI discussion on this conference call by WD-40, because frankly, it's not that I'm disappointed when companies talk about AI matters, because frankly, we've been talking in an interesting fashion about them with many companies around the world in many different sectors for a decade or so. But obviously AI has become such a tick in the box, a focus of people over recent months, that I kind of feel that many companies have just been saying the phrase just to kind of seem trendy or relevant, when actually far more important is, what are you actually doing that is relevant for your business, that is useful for your client base, that is going to make you a better, stronger company going forward? And if you haven't done that, to mention it. Sure, if somebody asks a question about it, say something, but you don't just put it in there to sort of look trendy or whatever. So I'm glad that WD-40 didn't do that. They talked a little bit more about digital commerce and related, not just about making sales, but actually an important point really, focusing on what's kind of relevant for their customer base, making sure that their products remain relevant and interacting with them. That's a big thing for WD-40 actually. The whole interaction concept is I think a real medium-term tick in the box actually for any company to thinking about it. So when I sort of look at those sort of key, more insightful issues from the presentation, it's an unsurprising thing really. I've liked WD-40 as a kind of a theoretical company for a long time, in terms of how they're approaching business, the orientation of it, good price mix, international focus, a product that I personally like and I can see its relevance for, is therefore the company, inexorably cheap and an attractive stock to own. Actually, interestingly, I don't think it is. I used to own WD-40 shares a number of years ago and made good money on them. But actually, it's a company which I think actually is not for me cheap enough to buy at the moment. And it's funny, we're coming back now down to, I guess, the sort of the valuation part. As you see, it's very easy when you think about corporate earnings to sort of immediately go to, did they beat or miss? What's my forward valuation work? And therefore, is it a buy or a sell? But as you see, I tick the box on whether they miss numbers or beat numbers. I spend a lot of time thinking about sort of insights from the conference call, from what the company's talking about, geography, future plans, their targets, what management are saying and related. Lots of insights from particularly the presentation. Not so much actually this time from the Q&A, where they only had a couple of analysts give some questions, but nevertheless, interesting stuff to listen to, far better than just reading a presentation document alone, far better to put it into context a little bit. But when we come back down to the valuation work, sure, there are things that I find particularly insightful. And for me, ultimately, some combination of EV/EBIT and free cash flow is a great sort of brief and easy to work out combination view as to ascertain whether I would regard a company as being expensive or not. In the case of WD-40, actually, I would observe that I'm still sticking with my medium-term view, the view I've had from earlier this year, that when I see the company shares at much nearer $150, I would regard them as a buy level, as a level that I'm interested in. And as I've said before, when you're thinking about investments, when you're thinking about trying to put together an attractive portfolio and related, don't just sort of ignore a company if you said, oh, it's a little bit expensive for me. I like the name, but, the valuation criteria doesn't work for me. Note it down. And so what I've done with WD-40, obviously can't show you on a podcast I'm just talking to, but I've got now a sort of a 4 or 5 page note here. I put all some key graphics in, some key insights, some thoughts, some valuation work, inevitably, boringly, and it's come out with, okay, so I put it into my spreadsheet that when WD-40 shares are getting closer towards 150, I'm interested. Now, as always, I will do something else, which is the critical thing is to go back to companies that you have high respect for. You tick the box on many levels, but the valuation is not quite right for you. The share price is not quite right for you to buy an investment. Note down the name and keep on looking at them. So I know in 3 months or time, when we have, again, another corporate earnings season, you can guess what the first company I'm going to be looking at is, and that's WD-40, because I want to. And I've done this now for quite a few years, and it will hence give me great insights, make me continue learning about not just this company, but how to think about companies, how to think about what the sector and geographic insights for them are, compare and contrast with other names, with the sort of the general macro views you get out there, general sector and individual stock views, pull it all together and keep that investment insight going. And hopefully it manifests itself as a better personal portfolio performance. That's obviously the ultimate aim. But hey, as I'm saying, the corporate earnings season is a great guide, great insight into all of this. And hopefully that's given you some sort of brief indications about how I practically think about it. I'm going to come out with another podcast right at the end of this week, probably on either Friday or Saturday, looking at sort of the next 3 or 4 days of the corporate earnings season. We've got some big numbers out, particularly on Thursday and Friday this week. Lots of people focusing on, for example, financial companies on Friday, but I'm looking at a range of different names on both days. So I'll come back with a further update then, and we'll keep this rolling for the next month or so as the corporate earnings season matures and new insights come in terms of different sectors, different companies, different geographies, buy, sell, drivers, and related. So hope that was useful. As always, thanks very much for listening, and goodbye.